Okay, well, welcome and thank you for joining us this morning for this Zoom presentation on charitable giving considerations for 2023. We are fortunate to have Danny Frederickson and Tim O'Brien with us today from Wealth Enhancement Group. They are located in Madison and offer comprehensive wealth management services. They manage Groundswell's investment fund and have been our partner for more than a decade. And with that, I will turn it over to Danny.
Yeah, I'll actually have Tim maybe start. If you want to go ahead, Tim.
Sure. So yeah, just one more minute on us. We work for Wealth Enhancement Group, and we help individuals, families, and organizations like Groundswell meet their financial goals. We have comprehensive financial planning, portfolio management, tax strategies, and trust services. So we try to blend all those into one place. And like was said earlier, it's actually been 15 years that we've been partners, and I've been with the firm for 25 years. And for the last 15, we were Thompson Plum, and then we were SVA and our Wealth Enhancement. And through that entire time, we've been the portfolio managers on the portfolio. So that's a little bit about us. We're also just going to briefly, talk about Groundswell, but more importantly, we want to talk about gifting strategies. Also, we've seen some changes in legislation, otherwise known as Secure Act 1, and then just this last little bit, Secure Act 2, and then what you might think about for your own action plan going forward. So as we know, there's really three main steps we think you need to take as you go down the path of supporting organizations. You really need to understand the mission of what's going on of the group that you're working with obviously with Groundswell. That's easy to do. You need to determine the best way to maximize your support, and it can be financially, but it can be in a lot of other different ways. And then we think, once you've made those decisions, you want to stay connected with the organization. And again, not only do we participate in managing the portfolio, we've also participated in events with Groundswell and support them in not just financially, but also in other ways. So we think it's a terrific organization. So going forward, we really want to take a look at what the best ways to support and maximize your support to Groundswell and to other organizations. So it's kind of the heavy lifting part of the portfolio. So I'm going to turn it over to Danny to take it from here.
Thanks, Tim. Feel free to jump in anytime though. So best ways to maximize our support. So kind of first and foremost, volunteer your time. All organizations need volunteers to kind of step up and volunteer your time, maybe even more than anything else. The second is going to be spread the word. Let other people know the organizations that you're involved in. Let people know what Groundswell is doing, and it might pique their interest to get involved as well. And then finally, we can do financial giving as well, which is kind of what we're here to talk about. So before we kind of get into all the different ways that we can give, what are some of the benefits of financial giving to Groundswell or other organizations as well? Well, by donating to a charitable organization, there's certain tax benefits. So we can take a deduction against our income tax, and allows us to do certain things with itemizing deductions. We can strategically bunch deductions, and that may help with certain things. The example that's given here on the slide is for qualified medical expenses. So in order to take a deduction for medical expenses, say you have a lot of medical expenses in 1 year, it needs to exceed 7.5% of your income. Well, if we're also doing some charitable gifting within that year, we can lower our income to help us achieve that 7.5% threshold. So from a planning perspective, it helps with that. And then also lowering your income through charitable gifting, again, can lower Medicare premiums. So if we think about our 2023 Medicare premiums are based on 2021 income, and similarly, our 2025 Medicare premiums will be based on 2023 income. So it's always a 2-year look back. So gifting in the current year could impact your Medicare premiums in future years by lowering your current year income. So what are some of the ways that we can gift and maximize our financial support? Well, the first one is going to be, like we just talked about, itemizing and bunching deductions in current tax years. The second one is going to be donating appreciated assets. The third one is going to be utilizing a DAF, which stands for a donor advised fund. And then the last one is going to be donating your required minimum distribution, or RMDs. So if we just kind of start at the top, itemizing and bunching your deductions. So an example that kind of lays this out pretty simply, but in a good way. So some of the assumptions, real simple, we're going to be having $20,000 in state and local taxes. We're going to have a $4,000 in mortgage interest. And then in example A, we're not going to be doing any gifting to charity. And in example B, we are going to be giving $20,000 to charity. So in example A, on the left-hand side, the standard deduction that everybody gets as a married filing jointly is $27,700 this year. And if we were to itemize, we would take $10,000 of state and local taxes and $4,000 of mortgage interest. So that will leave us with a total deduction of $14,000. In this case, we would just want to take the standard deduction because we would get the most money deducted. However, if we look at example B, when we're gifting $20,000 to charity, we still have the $27,700 standardized deduction. But if we itemize, again, we have the $10,000 in state and local taxes, we have the $4,000 in mortgage interest, but then we also have a line item for $20,000 of charitable donations. So that brings our deduction to $34,000. So in example B, when we're gifting a charity, we would want to take advantage of the itemized deduction over the standard deduction. And again, if we think about it in this example, $20,000 in 1 year, let's say that this person normally does $5,000 a year. But for whatever reason, in order to get the better tax deduction by itemizing, they do 4 years of gifting in 1 year in order to take the $20,000. Next is donating appreciated assets. So this is kind of your classic. I've held Apple for 20 years. I've held Microsoft for 20 years and haven't done anything with it. And it's grown to be, it's been a great investment, but I also have a lot of unrealized capital gains. And I have a lot of long-term capital gains associated with that. And when I go to sell that stock, I'm going to be taxed on that long-term capital gains. So in this example, the top line, if we simply sell XYZ stock, we're going to realize, and we bought it for $5,000, we're going to realize $15,000 in long-term capital gains. Well, we have to pay 15% on those capital gains. And so that's going to leave us with only $17,750 left to donate to the organization. The way that we would suggest by just simply donating the stock is we would have stock XYZ or, sorry about that. We would simply donate XYZ of $20,000. That the organization receives the full $20,000 exemption, and you get the $20,000 deduction, and the charity decides if they want to stay invested or cash out and take the $20,000 in cash. So really, we're trying to accomplish the same thing, but the way you do it is critical in terms of maximizing your impact. Third one is a donor advised fund. So again, this is an account that you would open up, and how it differs from simply donating an appreciated asset is you can put many things in here. You can donate cash, you can donate private investments, jewelry, artwork, or appreciated stock as well. And it goes into an account after you set that up, and that can be invested. You can assign an investment manager to that. And then over many years, it kind of gives you control to say, okay, this year I want to give 5,000. This year I want to give 2,000. This year I want to give 500. The next year I want to give 2,000. So really, you put a bunch of assets into the account, realize that tax benefit in the current tax year, but then you have control going forward. So a good example of this that we are recently working through with a client of ours is she had a big real estate transaction that she just closed on at the beginning of the year. And she's going to have about $1.5 million tax bill because of that, the sale of that real estate. So one of the things that we're looking at doing, and we're partnering with the accountant on, is opening up a donor advised fund, and really to try to fund that as much as we can to try to realize as much tax benefit in this year to try to lower some of that tax liability that she has from that big transaction. And then she'll be able to kind of give her gifting as she wants in future years, not only this year, but in future years as well. So she's not making that one-time big donation, but she's putting it in a donor advised fund so that she can spread out her donations throughout the rest of her life.
Yeah, and Danny, another example of if you just take the first two, 1 and 2, and combine them with the donor advised fund. So if you had $20,000 of Microsoft, you could put it into the donor advised fund. Schwab has a really good program for this. They'll sell it and you put it into, say, a balance fund, and then you get the deduction in that year. And then you also get the opportunity to gift it over time. And it's really, really a nice way. They also do a nice job of tracking your donations for you, and you can either gift them that way. So my wife and I did that process when we sold part of a business, and it was really a nice way of kind of controlling or using that gift over the next 5 years.
Oh, great point. Great point. And so the last one that we're going to talk about is qualified charitable distributions, which you can give from your individual retirement account or your IRA account. But before we kind of get into that, I just kind of want to go over a quick timeline of the IRA account. So up until age 59 and a half, when we're accumulating assets in a retirement account or our IRA account, we can't take any distributions. Otherwise, some penalties may apply. After age 59 and a half, we're free to start taking money out of there with no penalties. At age, and then so we're going to talk about Secure Act 1.0 and Secure Act 2.0, but prior to Secure Act 1.0, so prior to 2019, at age 70 and a half, you were required to take out by the government a certain percentage of the assets within that retirement account. The government is basically saying, you've had this beneficial tax treatment for so long. Now we want to collect our tax revenue on those dollars in your retirement account. So we're going to require you to take a little bit out each year. So that age was 70 and a half. At the same time, qualified charitable distributions were also at age 70 and a half. So you could use a qualified charitable distribution and your required minimum distribution at the same time. And we'll get into that, and we'll talk about what that actually means, but just to set up the timeline here. Then in 2019, when Secure Act 1.0 came out, that increased the required minimum distribution age to age 72, up from age 70 and a half. So again, that's the amount that the government's requiring you to take out. And then at the end of last year, December 28th or 29th, so there's only a couple days left in 2022, but Congress passed Secure Act 2.0, which again raised the RMD age to age 73, and will raise it again to age 75 in 2033, so in 10 years.
Yeah, and I think one of the important things on this is you're disconnecting two decisions, right? Mm-hmm. Before, you had to take money out and it would be taxed, and that was your required minimum distribution. And at the same time, you can make the decision, hey, I want to give a qualified charitable distribution because now I'm 70 and a half. Well, now this is great news for charities. They've kept that 70 and a half that you can still make charitable distributions, but you don't have to take a required minimum distribution till 73, 2.5 years. And later on, it's going to be till 75. So there's a big window there of an opportunity to gift and not have to take an RMD at the same time and still help with taxes.
Yep. So what is a qualified charitable distribution, and what does it look like? So if we look on the left-hand side, so if we're just thinking that we're in RMD age, so we've attained that age 72 or age 73, whatever your RMD age is based on the year you were born, let's just assume that we're in our required minimum distribution phase. So to donate to an organization, on the left-hand side, it's showing that we have our RMD, we're taking that, maybe we don't need to spend that money, so we're turning around and we're giving it to Groundswell, or we're giving it to another organization. We don't get any tax benefit on that. We're still gifting to the charity, and it's great, but we're not getting tax benefit on that. The right-hand side of the page then shows that if we take our same amount of money, the IRA RMD, but we directly gift it to the charity through what's called the qualified charitable distribution, that's when we get the tax benefit. So in that case, we're not taking kind of ownership of the assets. We're just saying, nope, from my account, I want it to go directly to the charity, and we're going to categorize it as a qualified charitable distribution. That's when that kind of tax benefit comes into play. So it's, again, it's not a, we're accomplishing the same thing. It's just the way you do it. We're gifting to charity either way. It's just important the way you do it in order to maximize your contribution. So if we just kind of back up a little bit and just think about RMDs and kind of what impact that has to you. So when you turn RMD age, this is a person who has a hypothetical $1 million IRA account, and their RMD age starts at age 72. So the chart shows on the right-hand side that at age 72, we're going to have to start taking out $39,100 of our account value. And then next year, we're going to have to take out another 40,000, and then another 42,000, then another 44,000. These are the amounts that the government is telling us that we need to take out on an annual basis and that we need to pay taxes on. And then if we take that and we think about our spending in retirement, the left-hand side is kind of what we think retirement will look like. We retire, we're going to spend a lot, and then it's just going to kind of decline linearly until we end up passing. The right-hand side is a little bit, it's a little bit better way of looking at how we actually spend our money. So we kind of get into retirement and we don't really know what to do with ourselves. And then we kind of get into the groove and we say, okay, we're going to take the kids on vacation. We're going to take a couple of those trips that we want, and spending really kind of starts to dramatically increase. That's kind of what we call the go-go years. And then as we kind of hit that peak and we've kind of gone on the trips that we want to, you start to enter the slow go years where you're not going on as many trips, but you're still going on vacation. Maybe you're going down to Florida for the winter time, different pieces like that. And then by the time we're kind of spending the least amount, which we call the no-go years, we're just kind of sitting at home. Maybe we have some health issues that have started to creep in. We're not really spending a whole lot. And then towards the end of life on the uptick is when we have to start paying for facilities and medical expenses. So what that does, that sort of graph shows, is that as our spending goes down and as our RMDs continue to go up, that leaves this extra money that we're required to take out of our IRA that maybe we're not spending, but we're required to take that out and we have to pay taxes on that. So how do we get around that? We get around that through a qualified charitable distribution. So again, if we are, the right-hand table just kind of shows if we have a $50,000 gift and our tax rate is at $30,000, our final gift is only going to be $35,000. If we have $50,000 gift and we do it through the qualified charitable distribution, our final gift is the full amount that we intended to give, and we're not paying the taxes on that amount. It's really a powerful tool. So to just kind of wrap up on the qualified charitable distribution part. So anybody who is age 70 and a half can use a qualified charitable distribution kind of regardless of your RMD age. That's one of the things that have changed over recent years. And again, it comes from a traditional IRA. We can't do it from a 401k or a company sponsored retirement plan. And then the maximum amount that we can give is $100,000 annually. With Secure Act 2.0, which again we'll touch on, that's going to be indexed for inflation. So some of the benefits, it can count towards our RMD. So we can reduce our RMD. If we have a $50,000 RMD, but we only need $20,000 of that to live on, we can reduce our RMD by gifting that the remaining $30,000 through a qualified charitable distribution. It reduces our income amount. And like we talked about before, it can help with Medicare premiums and help with itemizing deductions. So those are kind of,
okay. And Danny, just to add on that too,
yeah.
It goes up on the left-hand side to $100,000. But we have, when we're working with people do 5,000, 10,000. It's really what you want to give. And it's a dollar for dollar reduction of your actual income. And so that's that 30% of the government kind of helping with your gift, if you will, if you do it that way.
Absolutely. So those are kind of the 4 ways that we see the best way to maximize your impact when you're gifting. And then as we kind of stated before, it's it's very important to stay connected with the organization. So as we're kind of giving financial gifts, following up, saying, how are these being used? And Groundswell is a great organization for that because it's real tangible. We can kind of see what our donations are being used for, and the protection that those funds are being used for. Determine a long-term gifting strategy, get in contact with Heidi and really kind of lay out your plan for gifting with her, just so that she kind of has that in the back of her head. And then again, giving more than just financial support, donating time and spreading the word like we talked about before. Transitioning just a little bit into some of the Secure Act pieces that we talked about before, just to add a little bit of clarity around those. So in Secure Act 1.0 that was passed in 2019, that again increased the RMD age, required minimum distribution age, up to age 72. So we kind of touched on that, but one of the other key provisions that happened in the Secure Act 1.0 was the elimination of the stretch IRA. So just briefly, the stretch IRA was, if you were to pass, your beneficiary would be required to take money out, but they'd be able to take little increments over their lifetime. That is now gone. And now they're required to take out those bigger increments over a 10-year period. Why that matters is because typically what we see is when mom or dad passes away and son or daughter inherit the IRA, they're typically in their peak earnings years. So they're in a higher tax bracket already, and then they're required to take out more income. So that just kind of adds to their tax burden. So one of the ways to kind of get around that elimination of the stretch IRA problem is to start reducing your IRA. And one of the best ways to do that is by gifting through your IRA through a qualified charitable distribution, so that when you do pass, maybe that tax burden isn't as big for your beneficiaries. Again, it's not a bad problem to have by any means. I don't think anybody's going to complain about receiving an inheritance from mom and dad that they've worked so hard for, but it's just a consideration that we have out there when we're planning for clients.
I'll also add, it becomes a multi-generational planning process. Like, do you want to pay the taxes or gift part of your IRA now? And that way your kids don't have quite the same burden, and maybe use other assets or other things that don't have as big a tax implication.
So Secure Act 2.0, like I mentioned, that was passed just a couple of months ago at the end of 2022. And a couple of the key changes that kind of happened with Secure Act 2.0 was another update to the RMD, but then an update to the QCD, the Qualified Charitable Distribution that we've been talking about. So again, it increases the RMD age to age 73. So if you're a person who turned 72 in 2023 and you're expecting to take out your RMD, you don't have to anymore. That is now an age 73 issue. So it's going to be 2024 when you would have to take out your RMD. So now if you haven't started your RMDs, it's now age 73 when you have to start. And then in 10 years in age 2033, at age 75 will be the new RMD age. However, kind of the biggest thing for this presentation to remember is that the QCD age, the Qualified Charitable Distribution age, is again confirmed at age 70 and a half. So like Tim was saying, there's still that disconnection, and it offers kind of some real planning opportunities around the RMD. The changes to the Qualified Charitable Distribution. So $100,000 contribution limit, that's been in place since the QCD was introduced in 2006, and that amount has not changed. Now going forward, it's going to be indexed for inflation. So starting in 2024, there's going to be incrementally more, a bigger amount that you can give annually. And then the last piece that they changed for the Qualified Charitable Distribution is you can use a Qualified Charitable Distribution to make a one-time distribution to a charitable remainder unit trust or a charitable remainder annuity trust. From our research though, and kind of what we've been talking with different people, is the $50,000 contribution from your IRA through a QCD, the cost benefit is not really there. It costs a lot of money to set up some of these charitable remainder trusts and charitable annuity trusts, and for a $50,000 contribution. And if you already have a CRUT or CRAT, those you can't add the $50,000 to that. It has to be brand new money. So you have to set it up. So you can't say, well, I already have it. I already have it set up. I'll just put $50,000 in there. That is not permitted. However, charitable gift annuity is permitted. And we've talked to Heidi about that, and they have different ways of going about that. So briefly, what a charitable gift annuity is there's a pool of money. It kicks off income to you while you're alive. And then upon your passing, that money reverts back to the organization that you assigned to. So I'm happy to kind of take questions on that offline. I won't go into too much detail on it here, but again, another option as we kind of figure out the new ways of giving.
And, just to follow up with that, one of the best ways that we think you can support a charity is by naming them as a beneficiary for your IRA. So we've seen more and more of that happen all the time. So we've just had a client had just passed away, took their taxable accounts, gave those to the kids, and did their IRA and divided it and had it named to 4 different charities, and off it went. So I know Heidi can really help out with that part of it. We've seen it become a bigger and better way for long-term giving. Next slide.
There we go.
Yeah, so we just want to recap. We think that qualified charitable distributions are an excellent way to support charities. We talked a little bit just here at the end about naming Groundswell as an IRA beneficiary. Donor advised funds, especially for appreciated assets, are a nice way to take advantage. And with all of these different things, donate appreciated stock, with all these things, we really think it's important that you sit down with the caveat and work with your advisor. And again, we're kind of in that business, so we don't mind helping out with that part of it. So with that, I think we'll say thank you. We're under the 30 minutes that we promised Heidi by 1 minute, I think. And so I didn't know if there's any questions that anybody had for us.
I'm not seeing any chats in the chat box, but does anyone have anything that they would like to add? I could also take someone off mute if you wanted to speak directly with us versus via chat.
I would just add, thanks Heidi, and thank you Tim and Danny, that was very informative. I would just add, for people considering using a QCD and also potentially interested in a DAF, you can't use QCDs from an IRA to fund a donor advised fund. It's just not permitted by the IRS. So something to keep in mind.
Yep, great point.
And we'll have this presentation available if anybody wants to see it later, but also you have both Heidi and Danny's information here on the screen. So feel free to reach out if you'd like to talk about your personal situation with us. We'd be glad to.
Right, so I will add that I will share this recording. I'll post the link to our website, and I will also include a link to their PowerPoint presentation in case anyone would like to be able to access both of those as well. And then again, of course, reaching out to me directly. I can also put you in touch with Danny or with Tim, and then they both had mentioned also the charitable gift annuities. And we do have with us on the Zoom, Camille Zanoni from Madison Community Foundation. And that is our partner if you are looking to do a charitable gift annuity. Happy to talk with you more about that as well. Well,
great. Well, thank you, everybody.
Thank you, everyone.
Thanks, everybody. Take care.
Take care.